Hello and welcome to the FT headquarters. Last month, in January, at a time of extreme market volatility, PWM launched its first annual asset allocation survey, which we called Global Asset Tracker, as it tracks the investment and asset allocation intentions for 2016 of private banks. The survey was based on interviews with chief investment officers at 35 private banks, advising $7.5 trillion of private client assets globally. And today, in this first video interview of the GAT series, I have with me Florent Brones, Chief Investment Officer at BNP Paribas Wealth Management, to discuss market volatility, asset allocation, and also some of the survey results. Welcome, Florent.
Hello.
Hello. Florent, stock markets had a torrid opening in 2016, experienced one of their worst starts to the year on record. There were concerns about China's slowdown, a rapid decline in oil price, global recession fears. Do you think that markets are going to experience further volatility this year? There were some signs of stability this week, but do you think it's going to continue?
Well, the volatility will continue forever. I mean, it will never die, and we will always continue to have spikes of volatility depending on the main sentiment. As a matter of fact, today the sentiment is very negative, too negative in our opinion. The reality is not as dark as the sentiment seems to say today. So we would intend to use this current volatility period of time to increase positions in risky assets.
From the survey, PWM survey, it appears that 2/3 of the respondents believe that clients are going to reduce risk in portfolios. So even if perhaps the good thing to do is to increase risk or to take advantage of market correction, how likely is it that clients are going to follow your recommendation?
Right. It's always a very, very difficult question that you are raising because there is a discrepancy between what the advisors are advising and what the clients are responding. Risky assets will provide real returns. Today, the level of interest rates is extremely low, and it's not covering core inflation. It's covering headline inflation because of the decline in oil prices. But if you exclude the decline in oil and food prices, in fact, the returns are negative if you don't take risk. So that's the reason why we think sooner or later clients will have to take more risk if they want to cover their capital over the long run against inflation.
So what do you think, do you think are the main risks facing investors that could fuel market turbulence?
Well, you mentioned already three big risks: China, oil, the risk of recession or the discussion around the risk of recession. Also the banking sector, which is an issue because when the market volatility increases with a beta well above 1, the banking industry is under pressure. Concerning the oil price, I think the bulk of the decline is behind us. I mean, the oil price already lose 75% between above $100 to below $30. So I think the supply side of the problem is very difficult to manage, but it will be managed this year, and we will come back to a balanced market or a more balanced market.
And do you expect equities to continue to outperform bonds this year?
Well, we do expect that over the long run. It has not been the case in the last 2 or 3 months. In fact, equities have been underperforming bonds. Probably this is the risk of recession or the discussion around the probability of a recession on a global basis or in the US. We have seen a lot of discussions on the market about the efficiency of monetary policies and the fact that the Japanese move to a negative short-term yields was a big surprise for a lot of people. In fact, we don't share those concerns. We think that the risk of the probability of recession is very low, and we think that thanks to monetary policy and thanks to also the decline in oil prices, the domestic demand in mature economies will continue to be strong. We see the US continuing to create more than 150,000 jobs a month, and so we would be extremely surprised to see a recession. Mm-hmm. We will continue to have moderate growth, and that will be domestic-driven growth in mature economies.
Okay, so just looking at the high conviction calls, most of the private banks surveyed by PWM mentioned a tactical overweight to European equities. 80% of banks are overweight European equities, and also 60% are overweight Japanese equities. Is there the risk of, crowded trade in these areas?
The private industry is only part of the financial markets, and it's not because the asset allocators are telling you something that it is already the case. What I can tell you is that at BNP Paribas Wealth Management, we also overweight equities. We also overweight the European and the Japanese equity markets. But the flows of funds into those markets have not been huge. As a matter of fact, private clients are still very conservative, and they are still sitting on a huge amount of liquidity and bonds. So it will take time, in my opinion, for this money to flow into risky assets. Mm-hmm. Another part of the business is institutional money, yes. And institutional money is currently highly cash.
Okay. Just finally, do you think that investors should expect lower returns going forward in this new normal environment?
Well, with the kind of bond yields we have today, of course, by definition, returns will be lower than in the past. And from a fundamental point of view, we expect, as I said, moderate growth in terms of economic growth. We expect single-digit earnings growth. And we do expect only single-digit long-term returns for equity markets. And a big part of that will be dividends. So we advise our clients to be very careful in choosing the dividend returns, because it will be a big part of the total return for equity.
Thank you very much, Florent. Thank you.